Let us look at an example of a positional stock trade on the daily time frame chart. We have spent a lot of time looking at positional trades on the weekly time frame chart. However, during that positional trading series, I kept on saying that it is better to take the positional trade on the daily time frame chart than the weekly time frame chart if the daily time frame chart offers you a proper buy point. So on the daily time frame chart, when you are taking a positional trade, you are getting an early entry, but you are also incurring additional risk because you are buying the stock inside the base. On a weekly time frame chart, most likely you will buy the stock as it is coming out of the base because generally the pivot point is the 52-week high, especially bases like the flat base. For cup with handle, the early stage basis like double bottom, cup with handle, saucer with handle, or a normal cup without handle, the pivot point could be slightly below the 52-week high. But in general, from what I have understood on the weekly time frame chart, the pivot point is very close to the 52-week high. That is not the case with daily time frame chart. On the daily time frame chart, you might get early entry with, of course, some additional risk involved. And this chart that you see here on the screen is a good example of that. This is April 2024. So as per the SEBI regulations, we are allowed to discuss this chart because this is more than 3 months old. If you go back and check the fundamentals of this company, ITD Cementation, fundamentals were good. Triple digit EPS growth quarterly, high double digit sales growth quarterly. As of this date, I'm talking about, say, March or December 2023. Just go back and look at the numbers. So, this was most likely a positional trade. On top of that, the relative strength of this stock at this time was 88. Remember the importance of relative strength? The average relative strength of leading stocks of the past has been 87, and the relative strength of this stock was 88. That 87 number comes from William O'Neill's book, How to Make Money in Stocks. This was base one. That is another good point. Base one, relative strength of 88, and there were blue dots inside the base. Blue dots inside the base means the relative strength line for this stock was at or near the 52-week high. So the stock was showing good liquidity. It is not a penny stock. Millions of shares are traded daily. Uh, Price is good enough, about 20 rupees. So liquidity not a problem. Comparatively, I don't think there was a problem. We don't have industry group rank data historical. So I can't comment on that. But let's assume that the comparatives were in our favor. Technicals I will discuss. Fundamentals were in our favor. Market condition I have not checked at that time. But let's look at the base as a standalone daily time frame chart base, assuming all other criteria is in our favor. The first thing that would come to my mind is the risk inside the base. See, after point 2, there is not a single candle which has closed inside the green zone. Very big risk. Okay. See, no green zone closing does not mean that you reject the stock. It simply means that the base contains more risk. Okay. See, just because uh, airlines or aircraft crashes does not mean that you stop flying airlines, right? You still take the airlines. So you know there is risk, but you still fly, correct? Similarly, in the stock market, in the base, you know there is risk. Still, you have to take the trade. Now, an advanced discussion I would make here is if you find stocks in a given month which are breaking out of the blue zone which are not showing a single green zone closing, those kind of market conditions or in those months, you should be buying stocks early from inside the base. But there are times in the market when, unless the stock gives green zone closing, the stocks are not going up. That's a weak market. Okay, only those stocks which are sustaining in the green zone, like for example, giving 4 or 5 closings inside the green zone, those kinds of markets, they are tough markets to trade because you have to wait for the stock to give you those green zone closings and then probably take a trade. If they are not showing green zone closings, you are likely to lose money in that kind of market condition. So that's an advanced discussion. You have to be flexible. You have to see what market condition you are in. How will you know what market condition you are in? Well, you have to take test positions. Like for example, if you want to know whether this kind of stock will do well or not, you have to buy at least something to understand whether stocks are breaking out of the blue zone. See here, the closing price is in the blue zone, the buy point is in the green zone. So if I draw the base, this is point 1, that's point 2, point 3, and point 4. You go from highest to lowest to highest to lowest and so on. Right, so there are 4 points inside the base. The buy point is the high of this candle, which is 348.50. So let me draw a line, 348.50. And the distance between the closing price and the yellow line is less than 5%, which is what we want. So what is the criteria we are looking for? We want the price to be above the blue, the green, and the red. The price should be above the 50-day simple moving average. The 50-day should be above the 150-day, and the 150-day should be above the 200-day simple moving average. We are looking for a stage 2 confirmed uptrend stock. So first condition satisfied. What is the second condition? We are looking for at least 4 points inside the base, which I just showed you. There are 4 points inside the base. We are also looking for the slope of these moving averages to be on the upper side. So preferably the slope of the moving averages should be upwards. That's a strong confirmed stage 2 uptrending stock. So 10 candles, sorry, the blue, green, red, 10 candles, 4 points. These are the 3 basic rules. Blue, green, red are the moving averages. 4 points are the points that we counted inside the base, and 10 candles means from here, this is where the base starts. So next candle, from here you start counting 1, 2, 3, 4. You need minimum 10 candles inside the base. So this is the basic criteria that we look for. One of my YouTube subscribers sent me the name of a stock that he bought. And he said that as per your setup, I have bought this stock. But when I went and checked that stock, I found out that the green line was below the red line. So the basic criteria was not met. Okay, don't make that mistake. Blue, green, red, 10 candles, 4 points. Blue, green, red, 10 candles, 4 points. Blue, green, red, 10 candles, minimum 4 points. Okay, that is the starting point. Whether you are taking a swing trade does not matter. Whether you are taking a positional trade does not matter. Whether you are trading the daily time frame chart does not matter. Whether you are trading the weekly time frame chart does not matter. The blue, green, red has to be in your favor. Blue, green, red, 10 candles, 4 points. The 4 point rule can be relaxed if you are trading the weekly time frame chart because there you are looking at the pivot point. So you might be buying within 5% range from this 52-week high, 5% above the pivot point. Okay, not below. So no green zone closing contributes to risk. The distance between closing price till yellow line reduces the risk. All 3 conditions satisfied reduces the risk. Low volume inside the base reduces the risk. Strong fundamentals reduces the risk. Relative strength of 88 reduces the risk. Base number 1, which is early stage base, reduces the risk. The stock has a long way to go. Blue dot inside the base, which I cannot show you here. You can check it on the market smith chart. Blue dot inside the base, which represents very strong relative strength of the stock, reduces the risk. So there are so many things that are reducing the risk. Remember, recently I did a video on Vijaya Diagnostics, a blunder, a complete blunder, a trade that I should not have taken. Go back to the video last week, which I made on Vijaya Diagnostics. Although I made a blunder on that trade, I still thank myself for taking that trade, because if I had not taken that trade, I would not have made the video on that stock. And if I had not made the video on that stock, I would not have been able to show you the 9 risk factors that I saw in that base, which I don't see in this base. Correct? So, God has a very tricky way of doing things. I believe in God. So, God wanted me to take that trade. God wanted me to incur that loss. God wanted me to make that video so that I can highlight those 9 risk factors to you, and I can compare that video with this video to help you understand how I can identify risk factors on this base which are reducing risk, and how I could identify 9 risk factors in that base, Vijaya Diagnostics, which increased the risk. So when you begin comparing stocks, when you begin comparing bases, that is when you start to become a professional positional stock trader. That is how your experience improves. Recently, one of my students of my video course asked me about trade journaling. I sent him a video in which I talked about trade journaling. I do not recommend that you do trade journaling, but I do recommend that you keep a record of what you were thinking before buying the stock. So, probably taking a screenshot of the chart, taking a screenshot of the relative strength numbers, the market smith chart, which has all the data. That's called trade recording. That is not trade journaling. Trade journaling is a very tedious process. It requires you to calculate the numbers, the profit, the loss, to calculate the reward to risk ratio, your average gain, your average loss, and basically the statistics. I don't recommend you do that because it will take your focus away from the chart. You focus on doing the right thing, and I feel the numbers will take care of themselves. So you don't need to check your record. A good cricketer does not focus on his statistics, he focuses on his batting skills, or bowling skills, or fielding skills. And then the numbers over a period of time take care of themselves. So if you want to become a professional positional stock trader, don't look at your numbers. Focus on what you were thinking before buying a stock. Go back and check, were you buying a stock which was meeting your criteria, or were you cutting corners? Okay. Anyways, now that you understand how I study the base, this is depth. This is depth of knowledge. When you look at a base, you should be able to talk about a base for 10-15 minutes. I have been talking straight for 10 minutes now. Okay. That comes from within. Okay. I'm not using some checklist approach here. I just look at the base visually and I can discuss this with you. I don't use any automation. I am an old school guy. Okay. I don't use any computer coding, Pine script, automation, indicators, nothing. I just look at the chart. The chart tells me everything. Okay. I want you to develop that instinct, gut instinct. I want you to develop that feel for the chart. And that only comes when you scan stocks on a daily basis. When you look at 100 charts every day, that is 500 charts in a week, 2000 charts in a month, 24,000 charts in a year. If you look at 24,000 charts in a year and follow just one system out of the 1 million trading systems available out there, imagine the kind of expertise that you will be able to build with one particular breakout trading system. Just say no to all other systems, because this is the simplest of all trading systems that I have found out. Nothing can be more simpler than buying a stock that is breaking out of a base. Everybody can see that. Correct? This is not rocket science. Let us move the price forward. Okay, we are waiting for a breakout. So the breakout comes, high volume. The actual volume is 1.91 million and the average volume was 1 million. So the actual volume is more than 100% above the average daily volume, and the price has closed above the yellow line. That's a breakout. Okay, high volume, close above the yellow line, which is the buy point, not the pivot point. That's a high volume breakout. When that happens, the stock is likely to sustain above the yellow line. It might go up, come back to test the yellow line, and could continue to bounce from the yellow line. That is generally what happens in a healthy market. In a weak market, it might touch the yellow line, come down, or from here it might start falling. That's a weak market. And in a weak market, you might not get this much volume. Okay. So I will continue to move the price forward. I will not discuss trade management. By the way, from here, you would keep the stop loss at somewhere you will buy near the yellow line. So your stop loss would be somewhere here, right? 8%. So maybe somewhere at the low of this candle or somewhere at the low of this candle, low of these candles. Okay. And I continue to move the price forward. See, comes back to test the yellow line. Okay. Goes up a lot. Shake out here. Okay. Very high volume. See, continues to go up before crashing down. Let's see what was the move. Simple trade, right? This was 70% from 18th April till 4th of July. So May, June, 2.5 months. 70% in 2.5 months. Fantastic trade. And all throughout that, the stock continued to trade above the blue line, which is the 50-day simple moving average. So you must have heard me many times talk about the time horizon for a positional trade and the time horizon for a swing trade. I always keep saying that for a swing trade, your time horizon is 2 to 4 weeks with a double digit return minimum. So 10% and above return, if you are getting in 2 to 4 weeks time, I think you should sell all of your shares for a swing trade. But for a positional trade, there is no time horizon. As per history, the ideal time horizon is 6 to 24 months, as long as the price remains above the 50-day simple moving average or the 10-week simple moving average. I have said this a million times on my YouTube channel. If you saw this movement, the 70% movement in this stock in 2.5 months, the price never even came close to the 50-day simple moving average. Okay. If the price closes below the 50-day simple moving average, you can check the weekly time frame chart. If the price has not closed on high volume below the 10-week simple moving average, it is not a good enough reason to sell. A good reason to completely exit the stock, which is a positional trade, would be a high volume close below the 10-week simple moving average. So you will have to go to the weekly time frame chart to determine a complete exit. During that movement, you could have sold, you could have taken partial exits. Okay. Depending on whatever rule you are using, whether you are using 21 EMA, which I don't recommend for a positional trade, whether you are using some moving average or whether you are using some 20-25% distance to start taking partial profits, whatever trade management system you are using, whenever you do partial selling, you have to move your stop loss to break even so that you don't want to lose money on the remaining shares that you are holding as long as the price remains above the 50-day simple moving average or the 10-week simple moving average. So I talk a lot about green zone closings in my videos. And I always caution you, I always warn you against buying stocks which don't even show you green zone closing. But have a look at this. Also remember Tata investment that broke out in November, IRFC. BHEL. This was 2023 stocks. I just remember them off the top of my head. IRFC, BHEL, Tata Investment, Cochin Shipyard, GISC. The whole shipping rally came in 2024, middle of 2024. But even they did not show green zone closings. And those stocks shot up like 100% in a month. GRSC shot up 100% in less than a month, right? So, not every time do you need a green zone closing. However, when you are in a weak market where stocks are just not moving, in that case, I recommend that you tighten up your criteria. You demand a green zone closing. You demand that the stock be in the top 3 or 5 in terms of market capitalization in its own industry group. You demand that the stock be in early stage. You demand that the relative strength of the stock be high. You demand that the stock have blue dot on the RS line. You demand that the stock show high volume on the breakout day. When you make these demands, you are imposing stricter rules on yourself. You are significantly putting the odds in your favor in a weak market. In a lenient or a forgiving market, you could afford to take risk, because in those markets, what happens is you tend to buy a stock like this, which is not even showing you a green zone closing, and you end up making money, right? That money could be used to finance the risk on other stocks during the same market period, to buy stocks which are not showing green zone closing. Let me repeat that. In the same market conditions, when you are making money on such kind of stocks, you can use that money to finance the risk on other stocks which do not have green zone closing. That is the way you control your risk. So your decision to buy a stock does not simply depend on what you see on the chart. Your decision to buy a stock also depends on what is happening in your portfolio in your previous 3 4 trades. If you are making money in your previous 3 4 trades, that increases your ability and willingness to take a higher risk on your next or your fourth or your fifth trade. That's the advantage of trading in a lenient and a forgiving market. But in a tough market, you might take 3 trades in a row and lose money. All 3 could be test positions. That tells you that you have to stick to leaders. You have to stick to positional trades, avoid taking swing trades in those markets. That will come with experience. I cannot teach you all of that. Okay, it will come only with experience. Even trade management, which I cover in good amount of detail in my video course, I cannot teach you trade management. It is something that will only come from experience. I did my best in my video course to do that, but it's not a complete discussion. It cannot be a complete discussion. You will only learn that from experience and from what I'm sharing on this YouTube channel on a case by case basis, because trade management on 2 different stocks can be very different. For example, during that 70% move, the market condition could have changed. The earnings of the company would have been announced, or some elections in the US or in India would have taken place. So those in those times, trade management is very different. You might want to significantly scale down your position size in the stock, or move your stop loss very close to the current trading price to manage the trade, because in those cases you are worried about falling windows. But anyways, I'm getting too far ahead. Just wanted to discuss this beautiful base with you. Simple rules: blue, green, red, 10 candles, 4 points. The only thing that you need to learn is being selective and understanding which stock to buy in what market condition. I would not have bought this stock in a tough market condition. In a lenient market condition, I would have definitely bought this stock. So you understand the level of discussion that I'm making on this channel now. It's becoming more and more advanced. If you are really understanding what I'm saying, that means you are becoming a professional. You are beginning to think like a professional now. If you truly understand this entire video, this entire discussion, you are truly becoming a professional stock trader. Okay. Thank you so much.